How's everybody doing? We good? We excited? All right, we got a few more people joining. Good. Excellent. All right, so the first thing I'm going to do is I'm going to make sure everybody got the Excel sheet. Everyone got the evaluator? Yes? We're all good? Okay, so what I'm going to do, just to make sure, is I'm going to do something here. Add a new share. So I'm going to, 1 second. Okay. So I'm going to add a couple files here. I'm going to upload a couple files you're going to see. The cash flow sheet, I'm going to put it there. And also the tasks for the week. Okay. If you see those on your screen, you can click on them. You can download them. Okay. Okay, can everybody do that if they don't have it? Everyone should grab the task for the sheet because that's what I'm going to go over tonight. Task for the week. Okay. Now, if you're on not a tablet, but an iPhone or a Android phone, I don't believe it works with the download. You can attempt it, but you should have no problem with your tablet or laptop if it has access to some memory, reserved memory, and I'm sure most do. So, have any issues? Let me know. Okay, is everyone good? You are muted. Are you muted? I don't see you muted. You are muted? Do you mean as in you can't speak? Okay, so I'll tell you how this works. Okay, so the meeting is we put in our questions in the chat box. Once in a while, I'll get you to speak into your mic if you have it, just so we can communicate if something seems a little more complicated or we're talking about a property, just because sometimes it's better just to have somebody speak, okay? So if you look at the top of your screen, you should say there should be a mic option. You're muted now because you're all guests. You won't be able to turn on your mic, but I can change the status of you to allow you to do that. Not supported content. The documents? Is that what you mean? Good. Okay. What are you working on? What type of are you working on an Android? Are you working off a cell phone? iPhone. Yeah, iPhone you won't be able to download that. Yeah, cell phone. Yeah. That'll be tough on a cell phone. So in the email that I sent you for the link of this, I did put the cash flow sheet, the tasks of the week. I'm going to go over again. Yeah, you can get them later. Yeah, okay. All right, so let's do this. I'm going to hide this for a moment. Does anybody need this anymore? We're good with these sheets? Anybody need more time? Okay, Zach, do you mean from this, or you're trying to open the spreadsheet, something's happening? Okay, so when you open that spreadsheet, there's a macro in it. You should disable the macro. You don't need it. Yeah, if you're on your cell phone, you won't be able to download these things. So there'll be a macro in the spreadsheet. Please don't use it. You don't need it. Just disable it. And you have to enable it so you can enable editing, so you can actually put information in it. I'll go through that after we go through the tasks. Okay, I can open them using my Mac, but not get a note. Done. Okay, good. All right. I'm going to hide this now. Okay. The unsupported formulas were replaced. That's interesting. Okay, Zach, when I open up the spreadsheet, so everyone knows we're going to be going over the spreadsheet, you should open up the spreadsheet and follow with me if you'd like. I'm going to share my screen and you'll be able to see it. So that's how you'll be able to do it. No, Raphael, you're good. You're good. Anybody that's in the meeting that's not from the new group, it's okay. The room's open, so if you jump in now, you'll start to see other people jump in from different parts of the country. Don't worry if you're here. And this is a new group from Vancouver that we're inviting to our meeting, and we'll be reviewing some of the same stuff that you saw. Then when we get into the bigger group at around 9:30, we'll be talking about financing. Okay? All right. It works with Excel. Numbers a little different. It doesn't always work the same. I'm not sure. It works with Excel. Numbers a little different. Okay? Cash flow sheet is different from previous weeks, correct? This cash flow sheet is different from the previous weeks. No, the same one. Same. This is the main evaluator sheet that we use, okay? Okay, so this is what we're going to do. We're going to go through, because I want to make sure I get the tasks of the week for the group. Okay, the new group. This is on your sheet, okay? We went over some of these. Get a separate email. Everybody's done that, right? Everyone's got a separate email. You know this is to separate yourself from your private stuff from your personal, okay? You know, you don't have to use your business name for this email. If you wish, you can, but I would wait on that. It's not a huge deal. If you got a name that you already use or want to use, you can do that. It's not a big deal. The business card, when you set up that business card, you know that's what the name you're going to put on it. Okay. All right. So this is a create a separate telephone number. Create a separate telephone number. It can be set up via Skype, free phone line. Comwave's another one that I use. It's no big deal. It's a few bucks a month. Keep receipts, obviously, of everything that you spend, but you know, there's some free ones out there. It's not a big deal. Just create a separate line, just so you know that's the line that you give to people for your real estate business. Okay, just again separating it from the group. Okay, from the group of the other things that we do. Create business cards. So it can be set up via Vistaprint. They got a good program. There's some other print shops you can do it. Office Depot could be done. There's tons of places you can do it. For the sake of simplicity, you know, it's totally up to you how you create that business card, but I will tell you that I'm a fan of just simply a name and an email address. I wouldn't even put a phone number on it. I just put you know, just because this way you can control the communication, right? So you can put your full name. I wouldn't even put a business name. I just put your full name and nice and bold, centered in the middle of the card, nice stock, and email, and that's all I would do. And then if you want to give someone your phone number, you can. Okay. Same thing. You're creating contacts with people. You can identify the contact based on that interaction you have with someone, whether they're an investor or buyer or seller. Not a bad idea to give 2 of them out at a time, just so someone can pass them on to the next person. Okay. Then we have create a space in your home. We've already talked about that. That's important. Do not share this space with any other things that you do. Do not stay away from watching movies there, or streaming something, or even social media. You got to separate it. This space specifically for your real estate. It helps because it creates, when you walk into this space, it really tells your mind that you're ready to work and focusing on real estate. Okay, something I learned from my sociology professor. Okay, so create the space. Don't wash it down with any other activity. Any office supplies that we create for that space that we keep, we want to make sure that we keep the receipts. If you purchase a computer, same thing, keep the receipts. All receipts should be kept, taken to an accountant. Worst thing that could happen is an accountant says, we can't write it off. But better to be on the side of, trying to claim it and let them sort that stuff out. Get a mileage logbook, or obviously we can get an app. There's lots out there. MileIQ is something that I use. There's other ones out there. There's tons of them. Some of them cost money to open up the extra features. Totally up to you. Something to start tracking your kilometers would be an excellent thing to do starting now, because we're going to be using those kilometers for real estate investing. Obviously, the program that you're in is a write-off. The program, you know, any food, mileage that we used to get to the class last weekend, that's all something that's legitimately a write-off because it was related to our business. Okay. Okay. So, any questions about any of that? Everybody good? If you're good, type in Y or yes. Just to let me know that you're still there. Yep, there you go. Good stuff. Good stuff. All right. Good. Okay. Let's talk about the Excel sheet. Okay. So I'm going to bring up the Excel sheet. Okay. 1 second. Let's open that up. Give me 1 second. Now I'm going to share my screen. I'm just going to go on mute for a second. So when you don't hear anything, and I'll open that up. Okay, what I'm going to do now is I'm going to share my screen, and you're going to see the Excel sheet, and we'll go through that again, okay? Okay, 1 second. Yeah. Let's create a new share. Okay. So now I'm sharing my screen. Alright. Let's bring this up. Okay, so the black box that you see right now, that I can't get rid of. My apologies. That's so I can actually hear your questions. That's going to be in the top corner. I'm going to make this a little bit bigger for us. Okay, is that big enough? Do you need? Is that good? Can everybody see that? Everybody good? Okay. All right. So let's go through this together. Okay. So what we do with the sheet is it's helping us establish the income and expense statement for a property and give us an understanding of profitability. Okay. So when you look at this property, you don't see it. Can everybody see this? Can everybody see the screen? I don't know why you can't see it, Shiva. Is it? I didn't think it'd be a problem on the phone. Maybe it's because you're on the phone. Maybe, yeah. I'm sorry, Shiva. So what? You know what? Like I said, I'm going to put up the file for everybody to see. Let me try that. Okay. Okay. So here we go. Don't worry, it'll all be recorded. You can watch it again. And you have access to the other videos, which will allow you to see a lot more stuff we've been talking about, metrics and financing and contracts and agreements. Okay, so we have a property that's price is $1,700. You can just put any, the name of the property there. Don't worry about the 60%. 1.7 million. It's 35 units, $550 per unit. Total rental income on this property is Total rental property on this is 23100, so 231,000 per year. Okay, it'll automatically break out the average per unit right there for you. Okay, and we have laundry income. It's 240 a month. It's another 8,400 for the month. Okay, sorry, for the year. Total income is 239,400. Okay, so we have taxes identified at 7,341. That's $11.75 a month. We have insurance. You can see now, great. Insurance, $4,934. That's $411 a month. So we're just putting the amounts here. It's going to break down the month for us. So simple, okay? Gas, utilities, other. It could be anything. You can put in the others. I created those so you can put anything that's not covered in here. Maintenance and management are here. You'll see, okay, so here we see vacancy, management, and maintenance and management are established at 5, 5, and 10. Just to give you an example, if I change this to 10,000, oops, that's 100,000. What this will do is it will give an additional 8% to make sure that it equals 5% of the total value. So let's make that 0. You see it's automatically 5%. Does everybody see that and understand that? Yeah, a realtor would provide these numbers, or the seller. This is what I want to remind everybody. So we don't want to be shocked if somebody doesn't provide all the information to us, because part of the reason that they might be selling is they're a distressed seller or a tired landlord. So if they don't provide that information, we just have to make sure we verify it, and that would be something we would deal with in our agreement, making sure they provide income statements and the rent rolls. Okay. So management here, you see there's a 0 management. If I put 5,000 in there because they told me it was 5,000, it's going to add an extra 7.9% to make sure that we're covering the full 10%. Okay, so because it's 0, it automatically assumes it's going to cost us that per year, $23,940 as a management fee. Okay, so I was going to assume we want management on our properties. Yeah. It wouldn't make a difference, Peter. It's the most important thing is to have the costs, right? It's taxes, the cost of those things in there. That's the biggest thing you have to have, right? The problem with some people when they evaluate property, if they do it all, they don't include things like management, maintenance, and property management, and the vacancy. And you can see the vacancy here is 5%. That's minimum. That's what really hurts you when you get into real estate. You find out after you buy that those extra costs are there. So we want to avoid any mistakes moving forward. This is how we want to do it, by making sure we cover all costs. Okay. So vacancy is always a 5 minimum. Doesn't matter if you're going to an area where they say, oh, we have no vacancy. It's always 5. Okay. It's breaking up. Is that better? Can you hear me okay now? Okay, good. All right. So vacancy is 5%. If the vacancy was 7% in a particular area, we would go higher. So vacancy rate should be according to CMHC is higher. If it's higher than 5%, then you're going to go higher than 5%. So if it just go in 5s to be safe, So if it was 7, I'd go to 10. If it was 12, I'd go to 15. Just go in 5s, just to make sure that you're covered. We'd rather err on the side of, putting too much away for vacancy than too little. Okay. All right. So net operating expenses. So these are all the expenses that we have here that we've identified. That's giving us a total. That's $92,813. That makes up 38%, 38.8% of the total gross income. After we take that away from the gross income, the net operating income becomes $146,587. That's 61% of the total income. Now, for properties, this is pretty good in this case, initially at least, before we get into financing. Most of them are going to look more like, let's do this. Let me add another expense. More of them are going to look more like, let me see if that does it. Yeah. Almost half. Half are going to be, we'd like it to be more than half is left over after we pay our expenses, but this is closer to what you're going to see out in the marketplace, okay? Or inverse, right, where there's more expenses than income. That's not going to work for us, obviously, okay? All right, so financing. So first mortgage says 65, second mortgage says 35. The reason that's in green is because there's 35 units, okay? Now, if I went 4 units, okay? You see that it becomes red. It's because 4 units and less is considered residential. Give me 1 second. 4 units or less becomes residential. It's counted as residential property, and that would be pretty standard, 80 and 20. Okay, and you see it, they become green. Okay, so what we're going to do is we're going to go back to 35. Okay, but that's why it's in green. Okay, so residential is going to be 80-20 as a standard. Commercial is going to be 65-35. Okay, and here we're always assuming that we're going to do 100% financing, but these can be changed, right? I can change the amortization to 30 years, right? I can change the interest rate to 4 and say 6. Okay, those can be changed. Okay, all right. Here's some really good information for us when we're dealing with, you know, the metrics that we've now accumulated. We see that these metrics, and don't panic if you can't understand all this stuff the first time. You're going to test those 5 properties out that I want you to do this week. Yeah, excellent question. So the cap rate. So I'll explain these one by one. Okay. So cash on cash cap rate says infinite. Can anybody tell me why? Can anybody tell me why? Yeah, there's no money in, no down payment, so it's infinite. Okay, that's why it's green. But 30% is sufficient. You know, we don't have to have no money in, right? 30% is the objective. You know, it doesn't have to be 0 or infinite in the way of money. Average profit per unit is $97.77. 75, like I told you, was a minimum. We don't really want to go less than that. A little bit more would be nice, but $100 a unit, roughly $100 is great. Okay, because this is counting after we've paid everything. This is what we're making per unit. GRM is gross rent multiplier. Everybody get that? Gross rent multiplier. Now, GRM, you could say it says less than 6. 7's okay. It's not terrible. But GRM, the way GRM works is this. You take the monthly rent, you multiply it by 12, and you divide the value or the purchase price of the property by that amount that you get for the full year. Everybody get me there? Does that make sense? So if the income on a property was $1,000, I'd multiply that by 12. That'd be $12,000. And then I would take, say the property's worth $100,000. I would take $100,000 divided by 12,000. That's what would get me the GRM. Now the reason we like GRM, it's a quick calculator when you're just looking at property. So you can take the monthly rent, you can multiply it by 12 and divide by the value of the property, and it'll give you a good idea if the property is, you know, something we can look at. Now, do we want the GM to be higher or lower? Do we want the number to be bigger or smaller? Okay, we want it to be lower. We want it to be lower, and this is why. Let me explain. So we want the GRM to be lower because a lower number tells us that the rent, when we accumulate the rent over a year, it divides into the value of the property less times. Okay, so this is what I'll do. Don't worry about this. We'll come back to this, I promise you, and we'll go through these again. So if you don't totally understand GRM just yet, I promise we're going to go through it on one of our calls. I from time to time come back to it, and there's videos talking about GRM. Okay, current cap rate. Okay, it's 8.6. Okay, current cap rate. Now it says greater than 10 is what we're looking for as a cap rate. But this is what cap rate represents. Cap rate represents, imagine we paid the property off. So a $100,000 property, we've completely paid it off. After we pay all our bills, what do we have left? Say in a $100,000 property, we have $10,000 left. 10,000 divided by the value of the property gives us our cap rate. In that case, that would be 10. Does that make sense to everybody? So it's basically return on investment before financing. Cash on cash is with financing, depending on how much money we put in. But cap rate, it doesn't care if you put money in or not. It always assumes, you know, it looks at the whole value of the property and says, after we paid everything, what do we have left? What's the return on our investment if we paid the property completely off? Okay, we call it cap rate because it's not true return on investment, because return on investment would be based on how much you put in. Cap rate doesn't care how much you put in. It assumes that you paid the property off. Okay? It's still return on investment if you had paid the property off. Okay? Does that make sense? Anybody? Good. Is anybody confused? If you're confused, it's okay. You can say it. This is the time. So. Okay. No worries. No worries. Okay. Okay. So I'll go over cap rate because it's pretty important on one of our sheets. Okay. Okay. All right. No worries. No worries. And it's okay. You're gonna go through this. You're gonna go. This is the stuff that protects you. Okay. This is what protects you. GRM stands for a gross rent multiplier. Gross rent multiplier. Okay. I'll come back to those two. Okay. I don't want you to stress or worry about it. But these metrics are important to us because they protect us. Make sure that the property is in good health. Okay. As an investment opportunity. So we'll come back to it. It is important. But you're going to go through this. You know, you're going to go through this several times through properties. You'll get a better idea. I promise. Okay. Best thing you can do is play around with it and go through the properties, and you'll start to see, you know, what is an opportunity, what's not. Okay. So cost per unit, I don't want you to worry about. That's really for multi-unit, you know, big units. It says 48,000. We like to less than 45. The market determines that. So cost per unit, I don't want you to worry about. Okay. Coverage ratio, very important. Coverage ratio is very important. It says 1.39 greater than 1.2 is what we're looking for. Now, why is coverage ratio important? Let's go over here. So net operating income is $146,000. That means after we paid all our bills, right, before financing, that's what we have left, right? This amount, okay? So what this identifies to us is after we finance, this is our financing, after we finance this property, you know, do we have enough money from our net operating income to cover the debt, right? To service the debt, it's $105,000 a year. Our net operating income is $146,000 per year, okay? So basically it's saying that we have enough, more than enough actually, more than enough money to cover the expense, and we have some left over, okay? Does that make sense? Okay, so coverage ratio is basically saying, can you cover your mortgage? Can you cover servicing your mortgage, the debt on this property? You know, that's, do you have enough money after you pay all your bills to cover the mortgage, the debt service, we call it, debt service, to service the debt. So yes, in this case, 139 is great. If it's less than 139, that's unhealthy, because what does it mean? If this was 1, this was 1. Let's see if we can make that work here. Let me see. Do this. Let me put another so you can see what it looks like. Okay, 115. Now let's see if we can go lower. Let's go 30. 30,000. Okay, watch what happens. So what is it saying here? It's saying that it's almost exactly, we have exactly enough coming in to cover our property. Right, the cost of servicing a property. Now, institutions don't want to see this. Why? Because that means the property has to be perfect. There can't be any room for error at all, and we'll be able to manage it. Right. So we don't want the coverage ratio at 1.1. 1.2 is great. Okay, but if it was, let me do this. You can see. So this says, what does this say? This says, we don't bring enough money in from our property to cover the debt that we have. Very bad. Very bad. Okay? So this means we're going to take a loss. You see it right here. Average per unit loss of $21.28. We're losing per unit. So at the end of the month, we're losing money. You can see the cap rate is not very good in this situation, and that's going to affect us in a bad way. Unfortunately, many properties you're going to see. Some of you might have these properties, and don't worry, we can do something with that to try to improve that. But most properties run on this right here, coverage ratio. They're losing money. They're losing money. Okay, that's not what we're going to do. And I can tell you, if you follow the process, if you follow the system, you're not going to make this kind of mistake, because this will identify. We won't want to get into that property. Okay, very important. Okay. We don't want to make mistakes. This evaluator helps us, you know, avoid them by actually taking in all the metrics and all the numbers. Okay. All right. Any questions so far? Good? Okay. I'm going to continue. Okay. Can you give us a view? The system in this reference, I'm just saying the system of evaluating property. Just evaluating property. Okay? Just think of this. This is part of the system of evaluating property. So when we come across a property, we'll always run the numbers on it. Okay? We'll always run the numbers on it. And that'll be one of the initial steps that we make in evaluating a property and making sure that it's a good property. Then we get into financing and we get into other things, creative financing to execute the property. We're going to use the power team members when appropriate, lawyers, accountants when they're appropriate, realtors, mortgage brokers, the whole deal. Okay. When I say that, I mean always evaluate the property before we do anything else. Okay. Always evaluate the property. Should we see this property before we evaluate it? Should we be looking at property? No, you don't need to. You don't need to, because if the numbers don't make sense, what's the point? Right? Run the numbers. The property has promise. Okay? We'll do some negotiating back and forth, get it under contract. And if you really want, you can go see the property. And if you want to do it before you see, before you put it under contract, you can do that. That's okay. This is why this sheet here is to make sure that. Yeah, absolutely, Roman. You use this for residential property too. And now if you're doing it for a property, you're living there, obviously, no, right? On exercise, property and see what it would cost you to live there if you rented it versus owning it. Sometimes you'll find it costs you less to rent a house than own it, because of taxes, maintenance, and property management. Okay, a residential property, Roman, you use it. Now, if we were doing a rent to own, that'd be different. That's a different sheet. Okay, we'll get into that. Let's see, debt service, it's the account, or is it just the mortgage? It's the whole amount. It's everything. The whole amount. It's the whole amount. Everything. Because the whole payment is what you gotta cover, right? It's the whole amount. So when we see that debt service includes that principal and interest regardless of how you have it. It's looking at, well, what are you paying per year, right? To make sure that you cover it, okay? Okay, I'll speak up a little bit. There we go. There's a big white box. Yeah, that's expected. Don't worry, yeah, there's a box in the corner. That's you, so I can see you and your questions. So I can't really get rid of that without losing you guys from being able to speak to you. Okay, let's go down here. Now, valuation based on property value. What this does is it tells you what the property is valued for us. So even though this property is listed at 1.7, when we run the actual numbers, our value is 1,465. This tells us what this property is worth to us, and this is important because immediately we can see what our maximum offer price is. Our maximum offer price is 1,465. Yeah, it is awesome because it really helps. You should know what a property is worth before you start putting offers in. We can't. That's retail. 1.7. 1.465 is what we're looking for to make this work. Okay. Now we'll continue down. We'll see these same thing. The financing, but the financing it's a little bit less because we're financing now 1.465. We come over here and we see that our cash on cash is great. Our average per unit is 116, a little bit higher. GRM is 6.12. That's fine. Current cap rate you see is at 10, right? It has to be 10 or doesn't, for a buy and hold. Not so great for us. Okay. How can we cross-check to see if our calculations are correct? What do you mean by that? What calculations? On another sheet, are you using something else, maybe? Is that what you mean? Whether we have missed expenses. Okay, great. So obviously, this is a great question. Obviously, the expenses that we have here provided by the seller. Now, if the seller doesn't provide information or complete information, we get that information. So an income and expense sheet is something that we ask for in 7 or 10, 14 days in our agreement. to verify that the property is what they say it is, okay? But certain things, most of the time, you're not going to have a problem getting taxes, insurance. You know, if you don't see water or electricity or gas, you know, you can ask them, your utilities, you can ask them a simple question: do the tenants pay the utilities? Because if they're not, somebody's paying for them, right? It has to be the owner. So yeah, you definitely want to make sure that the property includes all those expenses. So if anything's missed, we'll pick that up in the agreement. Through quote, obviously you want to ask them, definitely, you know, is there any other expenses? Can you provide an income and expense statement? In the agreement, it actually requires them to do that within a certain amount of time to make sure that. Typically, you get this stuff. What you don't get is this stuff. This is what you don't get. Don't give you vacancy, don't give you maintenance, don't give you management. The reason is most people manage their own property. Maintenance, you might see maintenance. Some of them will give you maintenance, but it's often missed or not counted. And vacancy, they don't put in there. When you start putting these numbers in, it profoundly affects the value of the property, right? And it's obviously easier, or if you remove these, it would make the property look that much better, okay? So we're going to go down here. Does that answer your question? Good, excellent. Okay, so when we come down here, we can see that the cost per unit, I said I wouldn't care. It doesn't really matter at this point. Coverage ratio bumps up to 1.5. That's excellent. That means 1.5 times the income covers our financing 1.5 times. So this is very healthy. And you can see the average per unit is 116. It's not massive, but that's after you paid everything. That's after we paid, you know, every single thing. So it's important for us to be able to make sure that we're making money on each unit in the investment. Are you finding that the sound is breaking up? No? Is that better? Zenko? Is that better? A bit? A little bit? Okay. I'm not sure why. Does that sound okay? Sound is good. Okay. My apologies if you're having challenges hearing. Talk slower will help. Okay. Okay. I will talk slower. Okay. All right. Let's continue. Okay. So so you can see here it gives you the list price versus value of the property. You know, it's saying that it's 1.7. We're looking at 1.465. If we come down here, and this is the offer section, right? When we're looking at offers, first offer, we're saying 1.1026,000. Actually, what I'd like to do here, just for everybody, just bump this up to 85, and a lot of them actually bump to 95. This is healthy enough for discount. You don't have to worry about going lower. That's 70. 85 is fine. Okay, so when we go to 85, it's 1.2545 on the property. That's 85% of. That's 85% of this number. 73 is 73% of the actual list price. Okay, so it's telling you how far you are away from list price. Now you can see that's pretty deep, right? 26%. Now that's a cash offer. Cash offer. You can't hear anything. Are you guys hearing me okay? Turn up the volume. Let me ask you something here. I'm going to try something. Can you hear me now? Is this better? It is. Okay. All right. Okay. So much for using the mic, right? Okay. This is excellent. That's better. It's easier for me. Okay. Yeah. I'm a little feeling a little under the weather today, but you're right. You're right. Okay. So, how did you get the number of value of property? So the value of property. How do we get the value of property? Who can tell me? How do we get the value of property? Ten times the remaining amount I think you're saying, which is pretty accurate. I'm just going to elaborate a little bit. You see, when the income, all value for us, all value of properties is derived from net operating income. Okay, if the net operating income isn't why we're evaluating a property, then we feel that's dangerous, right? We need certain numbers to work for us, and we know that if a property doesn't have the proper metrics, we're going to lose. So what we do is we say, look, after I pay all my bills and I cover financing, well, actually it's before financing. If after I cover all my bills, the cap rate needs to be at least 10 for it to make sense for me to keep it, because I have to finance the property. That's why we use a 10 cap rate. Now, that's because of the current rate on mortgages and private money. If this was 1982, the cap rate would have to be about 25 for it to make sense. Your cap rate would have to be 25 for it to make sense. Can anybody tell me why? What was happening in 1982? What was happening? Yeah, it was highest interest rates ever, right? We're almost 22% in 1982. So if you have mortgage rates at almost 22%, which didn't last long, but it was there. It almost hit 22%. The government actually stepped in and backed it up a few points. Most rates were in the high teens, mid to high teens. So you could have a cap rate of, say, 25 and still make money. But if you had a cap rate of 10 in 1982, you're losing money, right? You can't make money on that, right? Because you have to finance the property. And we always want to finance properties. Why do we always want to finance property? Why is it important for us to always finance? That's right, Wayne, you're absolutely right. Return on investment, right? We have to use that OPM, right? So, yeah, and we'd rather not use our own money. And I'll tell you this, when you have the money, you won't use it. When you understand this, even when you have it, you're less likely to use it because it affects your return on investment, right? We don't want our return on investment to be low. The more money we put into a property, the lower our return on investment. We want to take, fundamentally, we want to take a low-risk opportunity and use leverage to increase the return. There is no such thing, in my opinion, of a 30 or 40% legitimate investment on its own, something that you can replicate over time. That's not real. That to me, that's Vegas. That's dangerous, right? Trying to get those kind of returns. And I know I've shared this with you. I'll share it with you again. Wealthy people take less risk, not more. This is a fallacy. People tell you hear this. You got to take more risk. You got to take more risk. No, we don't need to take more risk. We need to take low risk and find a way to increase the return. And the way we do that is through leverage. That's why leverage is so important. Because when you add leverage to a good opportunity, you're not adding risk. You're actually taking risk off. The more leverage you have on a property, the less risk you actually are taking on. Okay? That's how we build wealth. That's how we build wealth at an accelerated rate. Okay, excellent. All right. So when we come back here, is it possible to get a property at 73% of retail price? Well, I'll tell you that yes, it is. I think that what we're trying. Does anybody know what we're trying to do here? What are we trying to do? Now remember, I want everyone to remember something, okay? Why could we get a property for that low? Yeah, we're trying to find the bottom, right? That first offer is probably going to be a no. But why do we get better deals than other people? Yeah, absolutely. It's an initial offer. But why do we get better deals than other people? In this, when you're looking at that, Maria, you're saying about cash. Yeah, this would be like a cash offer. Yep, we're looking for a win-win. Solving a problem. There it is, right there. Okay. If somebody has a property and it's in perfect condition and it's in a great neighborhood, they don't need us. They don't need your help, right? They don't need my help, right? We're talking about people that are dealing with a situation, right? The situation could be, a personal one where it's divorce, downsizing, death in the family. Those things are personal, but there could be the property itself is slightly distressed or very distressed. And I want to remind everybody, every property is distressed. Every property that people live in is distressed. Only new properties are not distressed. Once you start living in a property, you distress the property, right? Everything's getting older. You're using it, right? So, you know, in a situation where you've lived in a house 5 or 10 years and maybe haven't done a recent update, that can accumulate quite a bit when you're trying to sell that property. So when a realtor comes into that property and evaluates the property, they're looking for a retail price for a retail state. Now, if the property's not in a retail state, they can't sell it retail. And realtors do not like to sell anything unless it's in retail state because it's difficult to buy, right? Sorry, my apologies, difficult to sell. So we want to, you know, in a situation like that where someone's in financial strain, you know, they've run out of money. Remember we talked about this, run out of time or run out of money. They don't have the extra $10, $15, $20, $30,000 or more to fix up the house to be able to get it in a retail state, plus the cost of the realtor. So for them, we become a solution, okay? And the big thing I want to share again, right? We're gonna go through a lot of properties, but we're not going to make mistakes. We're not going to make mistakes. We're going to make sure when we get that property, we're going to make money, okay? So the first offer, absolutely, we're looking for a no. 73% is probably a no. But you can see this. What have we done here? With the VTB, we've offered them $150,000 more just with the VTB. Now, why would we do that? Why would we do that? Why do we want, if they want time or cash, that's absolutely right. We're looking for time or cash. We're saying if you want time, no problem, we'll pay you cash. We want a discounted price. If they want money, we'll pay you more. We'll pay you more. We're just going to ask you to give us more time to pay it, right? That's the art of our negotiation style. So with a VTB, vendor take back or seller financing, we're asking them to put up a portion of the money to be able to finance this property, right? And it's the easiest way to find money in a deal is to ask the seller, look, can you do some financing for me? Do you wish to make some money on the mortgage? And they would be, in this case, like the bank, right? Yeah. That's exactly it, Dave. You're absolutely right. So look, we're giving them options. Do not give people ultimatums as a rule. You know, give them options, right? And each one of these options works for us. We're happy to do it. And you can notice something, that both these prices are below list. They're below even our price, right? They're below what we have. Now we're looking for a small no, what we call a small no. We're looking for, look, no, I can't do this, but can you do this, right? If we offer them a price and they say yes right away, what can we say? Well, we might have paid too much. We don't know if we got we got the best price. So we do want to hear a no on that first offer. Don't feel bad about it. Feel good. And you'll realize this as you start putting offers out when someone does say a yes to a low ball or lower than you expect to be accepted offer. Okay? Now, when we come down here, we see VTB with interest. We see VTB with interest here. Principal and interest, and here we say interest only. So VTB, interest and principal, it's $513 for both, right? We're asking for $513. Okay, does anybody know where this number came from? The $513. Anybody know where that number came from? Anybody want to guess? Sorry, it came from this number right here. Second mortgage. The VTB remembers the second mortgage, right? The VTB, identifies the second mortgage. Exactly. So if I change this to 455, okay, and I change it, because this automatically assumes you're going to put 10% down, but we're going to change that. We're going to assume that, we put up 55 from a financer and the second mortgage was 45, okay? That covers the whole thing. When we come down here, you see the numbers increased, right? They increased because the VTB is covering that second mortgage position that we've identified in our financing, okay? All right. So let's go back to 65 and 35, okay? Let me go here, okay. So 513 is the second mortgage. That's what we're asking for. Term is 5 years, right? Term is 5 years. Amortization is 30 years. Interest rate, this is interest and principal. Interest rate is 5%. The monthly for us is $27.38. The yearly is $32,857, and the balloon payment is $470,787.87. What does that mean? It means after 5 years, we need to pay this person the full amount. The remaining amount, $470,000. That's what's left on the mortgage after we pay the monthly for 5 years, right? That $32,000. So in this case right here, the seller is going to get the full amount, the remaining $470,000, when the deal is done in 5 years for us. Now we could extend that in 5 more years. You know, there's an option to extend it if they'd like to. 5% is not a terrible number. You could change that. You can change that to 6 or 7. It doesn't matter. The point being is that by getting the financing for them, that's going to help us from here. Okay, it's going to help us from here. All right. So with the financing. Now, does anybody notice something? When we come over to interest and principal only, $513,000, the term is 5 years, which really, it doesn't really matter, but it matters in the sense that we're going to pay it all back in 5 years. Amortization is unimportant because this is interest only. So in this case, we're actually going to offer them 6%. That's 1% higher than what we were going to offer them with interest and principal. Why do we want to do that? Well, we want to do that because that's actually going to give our monthly costs, it's going to go down. It's going to go down a couple $100, right? And if we can get our costs down per month, what's that going to do for us? What's it do when we can get our costs down? Exactly. It just increases our cash flow. That's exactly it, right? We're not in this game to own these properties or to pay them off. You know, that's not why we're in it. We're in it for cash flow. So we're asking ourselves, what do we need? How much do we need? You know, how do we structure this so this property generates the most absolute cash flow? That's what we're looking for. You know, we don't. The debt itself is just part of the operating cost of the business. We don't care. You know how long it takes to pay this off. If it took 100 years, it wouldn't matter. The focus for us is cash flow because the property itself will not produce a big enough yield in capital gains. There's just not enough money. You know, on the national average is under 6. It's around 6%. So, you know, trying to retire on 6% is in my opinion, slightly dangerous. It's really tough to do it. What is the amortization for mortgage payment years? Yes. So amortization means how many years it'll take to pay the loan in full. So what they do with amortization is they take the amount and the interest and they break it up over 30 years. You know, they break it up 30 years. They divide it basically by 30 years, which is 30 times 12 is, how many payments is that? 360? 360? 360. Is it? Well, 10 years is 120. Yeah, 360. 360 payments. I'm just talking to my friend Tarek, who's a mortgage broker and financial advisor. He's going to be joining us tonight as soon as I'm done this sheet and sharing with us some insight on how institutions will qualify you, okay? Okay, so in this case, we see that we go 6. The payment's going to be less. The yearly is going to be $30,000 because that's pure interest. And you can see, does everybody see that? $513,000. That's the total amount that was borrowed. We didn't bring any of that principal down for us. Do we care that none of the principal has been taken down? Do we? Does anybody? No, we don't. Right? No, right? Because we're looking for cash flow, right? So what is the best amortization that's available regularly? You can get 30 years with a mortgage broker. That's not insane. 25 years is the insurable rate. That's really what the 25 years is about. CMHC and some other institutions will provide that insurance. There's always insurance on a mortgage, but in a situation where you're putting less money down or the amortization is greater than 25, they're going to ask you to pay the insurance. When you do put 20% down and the amortization is 25 years or less, that's when the bank itself will insure that loan. No cost to you. Okay, so that's the sheet. I will go over it again next week, breaking down these things, the examples of what these things mean. Cap rate, GRM, I promise to do that with you, so don't panic if you don't understand all these numbers. All I want from you is to do 5 properties this week. And as a rule, if you can just maintain at least 5 properties a week, that would be great. You know, run 5 properties a week and see what you come up with. That's only 20 a month. If you want to do more, you can do more. That's great. If you come across an opportunity that you think is an opportunity, send it to me. I will bring it up and show everybody on the call and let them learn with us on that, and we can take advantage of that opportunity when I'm going it through for instead of one person through everybody. So yeah, GRM. Okay, okay. GRM is gross rent multiplier. Everybody got that? Gross rent multiplier. Okay. So what it is, I'm going to go away from the sheet here. Okay. I'm going to go back to our regular screen. Okay, so let's do this. Okay. No problem. Whiteboard. Give me 1 second. And let me show you this. Okay. So GRM, right, is gross rent. Oops. Multiplier. Okay, there you go. Everybody got that? Gross rent multiplier. Okay? Alright. Give me 1 second. I'm just going to catch up with these questions. Do you run properties from MLS? You can, Vivian. I mean, you can. There's no problem running properties but again, you're probably going to see most of those as retail, right? So you can. If you think something is an opportunity, Vivian, absolutely do that. What are the other tabs for? I don't want you to deal with the other tabs right now. There's some conditions in there, and it can help generate an intent, an offer to intent to purchase, where it's not a formal offer. I'll get into those at another time. Okay, just focus on that one sheet. That's the most important thing to you. Okay, thought I could run single family homes on the sheet. Yeah, you can. You can run for single family homes on it for numbers. Sure, you can. Not if you're doing a lease option. Obviously, that's not going to help you with the lease option. But you can get an idea, actually, Rodney, of if you took away the expenses, right? The expenses away from it, what it would cost you. It would give you a good idea. Okay. So gross rent multiplier. Here we go. If you're only renting, yeah, it's only renting, Rodney. Yeah, exactly. Okay. Now here it is. Ready? $1,000. Somebody you walk up to a house. You check out a house, and you say, what's the rent? They say $1,000 per month. You're like, okay, cool. And what's the purchase price of the property? What are they asking for? And they say, well, the property is $100K. And you go, oh, okay. And this is what you do. Right on the spot, you can get a quick calculation to see if there's an opportunity. How do we do that? We take the rent times 12 equals, in this case, how much? 12,000. Right? Per year. Oops. Per year. And I divide, then I take this number, and I take 100K, this number up here, and I divide it by this number here. So how many times does 12,000 go into 100K? Who can tell me? $100K divided by 12,000 is how much? 8.3. Yeah, 8.5 is fine. 8.3. Okay. Now, what number were we looking for in the sheet? What did it tell us? What was it? 6. Yeah, but 8's fine. Don't think 8's bad. You can work with an 8. That's fine. Fine's 8. But just see what it does for you. It can give you a quick idea if a property is even worth looking at. Because if the purchase price is so high and the rents, don't even come close. Like, I'll give you an example. Here's an example of what I mean. If you have, let's do this. 1 second. Let's pretend. Let's take another example now that we understand it. Okay. If I had a property and say the rents were $2,500 a month, right? Sounds pretty good. The value of the property, though, is $500,000. Okay? If I'm given these numbers in gross, though, Francis, in gross income, yeah. Does it mean 8.5 years to pay it off? Yeah, but that's a gross number, right? That's before expenses, right? This, Zenko, that's tougher to do because we would have to take in expenses, right? If I did a 10 GRM, but the expenses were low, it's possibly a good property, right? But let me walk you through this, right? This is just to give you a quick idea, right? If it's a 10, you can still run the numbers on. But if it's, watch this. So 2,500, we take, it's 2,500. We say, yeah, okay. 2,500 times 12 is what? Who can tell me? 2,500 times 12 is, yeah, 30 grand. 30K. Okay? Now, what am I supposed to do? I'm supposed to take 500,000, that's the purchase price, 500K, and I divide it by 30K. What's that give us? There you go. 16.6. This is a crappy property. I can tell you right away. It's a crappy property. It's not going to make any money. Right? Why is it not going to make any money? Who can tell me? When do you say enough is enough? In GRM? GRM, if you get it into the 10, I'd say 12. Don't waste your time over than 12. Yeah, don't waste your time over 12. I'd say 12 is right on the edge. I mean, it would have to have really low expenses, but 12, look at it. And you'll see as you run these numbers, you'll be amazed. The more you run that sheet, the more you understand these metrics and these numbers and what they mean and how important they are to you. So when you get it, see, when someone tells you I got this great real estate opportunity, just by running GRM, this is why we like GRM. It's a quick calculator. Just by running GRM, we can say, yeah, thanks. This isn't something that kind of fits my profile, but I really appreciate it. Because if this thing is 16, we already know. What do we know? Well, this 30K, immediately I got to cut this in half, right? Half of that's going to go to expenses, okay? Half of this 50K is going to go, 30K per year. That's expenses, income, bills, taxes, maintenance, vacancy, property management. So what's left at the end of the property? 15K, right? Well, 15K is the net operating income. I'm putting up 500K or taking on 500K for 15K. Well, what does that mean? Well, that means that, here we go. That's the same thing as saying 15K divided by 500K equals 3%. That's what I would be making as an ROI or cap rate. This would be cap rate against this 500K. This is horrible. This is horrible. But you know what's funny? Well, not real funny. Most people right now are investing at 3% cap rate, and they're losing money. And the reason they're okay with losing money is because they've been told that it's not about making cash flow, it's about owning the property. Okay? Yeah, that's right. Yeah, either higher rent or lower price. Yep. Should we try to lower the price then? Yep, we'd have to get something working for us. Obviously, there's limits on rents, right? There's market rent. You can't really go higher than how you can go higher than that is going to be a problem. We can't magically just say, well, you know what? We'd like the rent to be $5,000. Now, you could legally do that in Montreal because you could just change the rent in Montreal. But most provinces have rent controls. Even in Calgary, my apologies. In Calgary is where you can raise it. Did I say Calgary or Montreal? My apologies. That's Calgary, not Montreal. So in Calgary, you can raise the rent. You just have to let them know. The thing is this: in Calgary, they still have a market. The market's going to take care of that. If you put up 5,000, your numbers might look good, but you cannot rent it. I mean, now your vacancy is 100%. So we're not looking for that, right? There has to be a balance, okay? All right, we good? So Kyle, appropriate rents. Here, I'll give you a site real quick that I use. Hold on. In 1 second. I've shared it before. I'll give it to you again. Hold on. It is. Does have a link for it? Hold on one sec. Okay, there we go. Hold on one sec. Here's an example right here. If you want to look, I'll give you one real quick. Okay, there's other sources, but here. Okay, check that link out. That's for Calgary. Check it out. It's really cool. Everybody click on that link to give you an example. And those are based on actual listings. So check it out. See what that shows you? Pretty cool. It shows you based on, you know, the average on the listings, you know, what properties they're going for. And that's right now, that's what it's telling us for Calgary. No worries, my pleasure. So it's telling us bachelor, commercial property, condominium, duplex, eightplex, fourplex. It's right now it's house. It's looking at house, but you can click any of these, right? I could click duplex, and it's going to give me the duplex rates, okay? And it's going to go bedrooms. Does everybody see that? Or when you fool around with it, no worries. It's the same site. It's just you can pick the province that you want. Same site, okay? All right. We got about 25 minutes left. I want to bring on Tarek and let him share some insight on how properties are, you know, are viewed by institutions. My pleasure. How they're viewed by institutions in financing. He'll explain how they evaluate you and what you need to be able to be qualified for loans. Also, he's going to share with us and identify. We only have 25 minutes, but he's going to do the best he can to get as much as he can in. He's thankfully agreed to show up once a month to this group. I really appreciate it. He's an amazing financial advisor and mortgage broker, and he's part of my team. So if you're interested in his contact, just let him know. He can throw that up for you guys, and you're more than happy to reach out to him. Now, if you do reach out to him, I just want to make it clear, I'd like you to reach out to him for financing, or if you want to do financial advising, just because if there's questions that you have, it's general questions, I want you to wait till he shows up on this, okay? I want you to wait till he shows up on our calls once a month, and then he can share that information, okay? All right. Why are you asking? Of course we can. Yeah, all right, Marina. No worries. I'll let him do that. Okay, cool. All right. So I'm gonna bring up a new whiteboard, and Tarek's gonna jump on.
Do you have the one from the last session?
Oh no. It's somewhere. Yeah, I wipe it clean every time. Oh, sorry, pal. Okay. But it's as you can see, it's relatively easy when you're just doing it that way.
Is most of this group new or most of them?
They're all over. We got 40 people on tonight.
Okay.
All right. Here we go. This is Tarek. He's gonna jump on the call and share his deep wisdom on financing, and right now we're gonna focus on how institutions finance you. Okay, go ahead, Tarek.
Good evening, everyone, and thanks for taking the time to get on this call with me. Last time we spoke, we talked about the 5 C's of credit, and the reason why we talked about the 5 C's of credit is they make up the cornerstones of all lending requirements. So we're going to get into each one just briefly here, and then just to kind of provide an agenda for the rest of the call, we're going to look at a couple of the mortgage insurers here in Canada and some of the programs that they have available, especially the self-employed programs.
New immigrants?
And new immigrants as well.
Yeah.
So we can talk about some of those.
Yeah.
So we'll dive right in here. Excuse my penmanship. So regarding the 5 C's of credit, I'll try them out for you real quick, and then we'll get into each one. 3 of them are tangibles, and 2 are intangibles. So we'll talk about the tangibles first.
Smaller is better.
Okay. So capital is your down payment. That's the first C of the 5 C's of credit. The next one's capacity. This is by far the most important one. I'll explain the acronyms in a second. The last two are the intangibles. It's your character.
That's important when it comes to relationships with the institution that you have.
The last one is creditworthiness, or credit. Okay, can you bring up a new page? So if everybody can just take a snapshot of those are the 5 C's there. Yep.
Yep. Everybody have that? Everybody good? I'm gonna put up a new whiteboard.
So yeah, we'll get into each one of them now. So capital is straightforward. It's your down payment, right? So depending on the deal that you're taking from the lender, it could be as low as 5%. It could be as high as 50%, depending on what the deal is and what the structure looks like. If you're buying a home in Canada, 1 or 2 homes, it's your 5% down payment, basically, right? That's the capital. Yeah, it's it's GDSR and TDSR. Those acronyms form part of the capacity portion of the 5 C's of credit. And what that basically implies is there's some ratios, and these are the same ratios that pretty much all lending institutions kind of use when gauging how much credit is available. And basically what it boils down to is this: what are your expenses as a ratio of your income?
Just so you know, you can change colors here.
Oh,
you want
perfect.
to make it easier to think.
Okay, so we'll get right into capacity. So capacity is your ability to service your debt. Okay. Yeah. So there's some questions there. Can you explain the 5% versus 20% down payment? Okay. So if you're buying, for example, if you're looking to buy a couple of homes, one for yourself and one for a rental property, for example, you're allowed to do that in Canada. You can pay 5% down payment on your first and 5% down payment on your second. As soon as you get into a third property, most lenders are going to require a 20% down payment, right? So if you're only putting down 5%, that means you require mortgage insurance or default insurance is what we like to call it, and you'll need to get that through one of the 3 main insurers here in Canada: Genworth, CMHC, and Canada Assure. Okay, so if we can get right back into capacity, so the first ratio that all lenders are going to look at is your GDSR, which is your gross debt service ratio. So take your income. Let's just use the example of $100,000 of income. Okay. So we have $100,000 of income, and what is the debt as a ratio of your income? So the debt that they're looking at specifically under this ratio is your principal. So this is the principal on the mortgage, the principal payment, and interest. It's your property tax, condo fees if there are any, and the last one is heat. Those are the only things that show up in this ratio. All right. So if you've got $100,000 a year of income, we're talking gross, we're not talking net, and the mortgage payment, let's say, is $2,500 a month, and your property tax is another $500. Okay. And let's say there's no condo fees, and then heat's $100. So your gross debt is basically $3,100. So at $3,100, per month. If you divide that by your income, so if we take $100,000 a year, divide that by 12, Sam, what do you got for me?
Yeah. 100,000.
Or here, you know what? I'll just multiply this by 12. That's probably easier. So that's 36,600. Okay, so you're basically, what we're saying here is 36% of your income is getting eaten up by property tax, principal and interest payments on your mortgage, and heat. So in this case, you would fail right off the get-go. So nobody would give you a mortgage using these numbers, right? The magic number is 32%. That's what we're aiming for. Get in the new sheet. So the number we're looking for is 32%, guys. Sorry.
You put it on.
Okay. 32%. That's correct. Now, some lenders will go as high as 38, depending on if it's a commercial deal or a residential deal, depending on how much insurance is here. But typically, most homes, most lenders, you're looking at 32%. If you pass this, and this just tells you, it tells the lender what your ability is to service your debt, right? So if you've got $100,000 a year of income, but you know the property is going to cost you $40,000 a year in payments, well, that number's too high. And because that number is too high, you don't qualify. Regardless of how much of a down payment you're putting, regardless of how much collateral you have, they're not gonna bite on this because you still have to be able to service this debt, right? I mean, if you're off by 1 or 2%, they'll make exceptions for you. If you're talking over 40%, nobody's gonna make any exceptions for you. That's the first, litmus test that they're gonna put you through to find out if you qualify. Those are the only things that are covered under GDSR, by the way. There's no other inputs in that calculation. It's income divided by property tax, condo fees, heat, and your mortgage payment, which includes principal and interest. If I'm talking too fast, let me know. Is that total income or income from the property? So that's your income. So that's income from your work, from your self-employed earnings, whatever that is.
Yeah, this isn't even coming to your property.
But we can talk about that as well. So if you've got a rental property, they will take half of whatever income you're getting from that property and count it towards income for yourself.
And that's gross income,
right?
So they're immediately counting 50% of it to expense, so just like we would in general, right?
So if you've got a rental property that you're collecting $2,000 a month of rent, they're going to take $1,000 of that $2,000 and include it as income for yourself.
So when we have properties that produce high income,
income is before tax. They're looking at gross income. So if your gross salary is $100,000 a year, but after taxes and deductions, you're only taking home 65, they're looking at the 100. They're not looking at the 65. And then in terms of the rental property, they're looking at whatever the lease agreement shows. They'll take half of that. So if your lease is $2,000 a month, they'll take $1,000 and include it as income.
And often they will ask for leases, on property,
So you divide 36 by 100, exactly, right? So it's a percentage. So what are your expenses as a percentage of your income? How does our 3-tier structure affect this?
Oh, this won't have anything to do with the 3-tier. You'd still have to qualify as an individual. Your company would have to qualify if it was the one holding the paper, the mortgage.
So you're looking for the percentage, right? So if your income is $80,000, for example, and your expenses are, let's say your expenses are $2,000 a month, it would be $2,000 divided by the 80, and that would give you your percentage multiplied by 100, right?
And this is why it's hard for people to see it initially.
No, sorry, insurance does not count in debt. So that's the first ratio. The GDSR is the first ratio. Now, when you say insurance, are you talking about the default insurance, like the CMHC insurance fees? Francis from Vancouver? No insurance we have to pay on their property. No, that doesn't get included. They're not looking at that. So now I'm going to show you the second ratio, and this is going to clear things up for you.
Yeah, I just for them, they're not looking at your specific expenses for the property. What they do is they immediately just take half of the gross income and allot that for expense. Right? That's their quick calculation. So this is where it becomes important, as I was saying before. People don't realize it, but it's easier to get a larger loan than it is a smaller loan, because a larger loan, your income doesn't matter. It's too small. You won't get the loan unless the property itself produces the appropriate income to cover that expense. Just gotta press that.
Okay.
There you go.
So this one here, this next ratio, we have a limit of 42%. Some are at 40. So this is the next litmus test or ratio that you have to qualify for in order to get approval. So if you pass the first one, it doesn't mean that you're through the door. You still have to pass the second one, right? So you've got your 5% down payment, you've got your capital, now we're at capacity, you've passed the GDSR test, now we're doing the TDSR test. TDSR takes GDSR and adds the following. It adds all of your credit cards, lines of credit, personal lines of credit, or secured lines of credit, and includes your loans, car payments, any sort of debt obligation. Not talking hydro, we're not talking Rogers, we're not talking your groceries, we're talking strictly credit facilities. So your credit cards, your lines of credit, your loans, and your car payments. These are fixed payments. If you've got a student loan, it's a loan. It counts as a debt. Okay? So what they're looking for here, and this is where it depends on the lender. So if you've got a credit card balance of, for example, let's say your credit card balance is $5,000, and you've got no loans, no personal lines of credit, maybe you got a car payment of $300. What they're going to do is they're going to take, so 42 is the percentage is the magic number, correct? Zach in Vancouver. 42 and under. Now, again, there's exceptions can be made if you're at 43 or 44 and everything else looks good. Remember that. But at some point, they're going to cut you off, and that's typically around 42. Okay? So if you've got $5,000 of credit card debt, they're going to take 3% a month and include that as the payment. So they don't care what your actual payment is on that credit card. Maybe your minimum payment's $5 a month. They're going to take 3% of the total balance and multiply that by 12. So 3% of 5,000, you're looking at $150 a month. Multiply that out by your 12 months. So this is $150 a month here. On top of the $300 car payment, you're looking at $450. So there's an additional $450 a month of expenses on top of the other screen where we had the GDSR, which I believe was $2,500.
Yeah.
Yeah. Okay. So now you're at $2,950. Well,
just want to make a quick point. No,
Yeah.
I'm sorry to interrupt. So the reason that the credit cards that you hold, typically they're going to charge 3% regardless of your balance on it, is most credit institutions are working at a 3 or even 2% minimum payment on the balance you have. So they make the assumption that if this person takes this credit card and taps it out, what can they afford to pay? And their monthly payment on a card at $5,000, fully tilted, is going to be around $150 a month. That's why Targ's put $450, because $150 for this, for the credit card, and $300 for the card payment.
Question there, percentage magic. Okay. Would it include debt on current mortgage? So your current mortgage would be included in the GDSR, right? So back at that other screen where I showed you the mortgage and the principal and interest of $2,500. Was it from the back there?
Yeah, here, let me just move that. Oh,
Sorry.
sorry, where did we go Hold on one sec, I just lost it. Okay, I'm just trying to move it over for you. There they are up there. Oops. There we go. Is that the first one or the second
Yeah, that's
one?
the first one. That's
Okay.
GDSR. Okay, so we've got principal and interest at $2,500. Okay, so over here we're at 3,100. So 3,100 at this page,
Okay.
and then we had another 450. So you're at 3,550, right? So we take 3,550, multiply that up by 12.
Let's do this actually. That was better. There we go.
There we go. 3,550 by 12.
3550 by 12.
And then
3550
by 12.
divided by 12 equals 295.83. The problem is we can't see them. Let's see.
Do it again. So 3,550 is $42,600 a year. Take me to the other screen.
It's this one.
So 42,600 a year on 100,000 is 42.6%, right? So you're just over by a little bit, right? So in this case, you're at 42.6%. Some lenders might say no, some might say yes, but it's very easy to get some of these payments down. I mean, you can go to your credit card company, put down $1,000, bring your balance down to 4,000, and now you've qualified, right? So just because you've hit those numbers doesn't mean the doors are going to close on your face. It just means you got to bring them down somehow, right?
You gotta adjust it.
Yeah, so
yeah.
either you're going to borrow less, you're going to put a bigger down payment, you're going to borrow a different amount, pay off some debts, etc., etc. Let's get back to the questions here. Okay, so the T in TDSR is total debt service ratio and gross debt service ratio. So the first one's the lower number. It's your gross debt, right? It's just gross. It's just, okay, your property tax, your principal, your interest payments on your mortgage, heat, and condo fees if you have any. TDSR is your total debt. What is your total monthly debt obligations? We're not talking Groceries and Rogers. We're talking revolving credit, mortgages, loans, lines of credit, credit cards, card payments, etc., etc. Janice in Vancouver, is GDSR considered in the cash flow analysis to ORFR? So in the cash flow analysis, we're not talking meeting any lending requirements. That's a whole other topic. That's what I'm here to discuss, right? So we're going back to the 5 C's of credit. We talked about capital, which is your down payment. The next thing we talked about is capacity, which is your ability to service this debt. When a lender looks at capacity, they're looking at GDSR, TDSR. They're all looking at those exact same things, okay? The next part we get to is collateral, right? So when we're talking about exceptions, let's say somebody's at 43 or 44% TDSR, but they've got $200,000 in the bank and they don't want to touch it, and they can take that $200,000, pay off their credit card, and now they're under the 43%. Well, let's say they don't want to for whatever reason, and they've got this money in the bank. They're going to look at the collateral as well. The next 2 C's are character and credit. Character is yourself. How long have you been at your job? What type of income do you have? Are you jumping from job to job every year? What do you look like to the bank, right? How long have you been banking with them?
And would you also include the relationship you have with the banking
Yeah, the
institution?
relationship.
Sure,
Yeah,
right?
I mean, if you just showed up there and you
if you're brand new, that's gonna you have no relationship. They have to use what they know, right? But if you've been banking with them for several years and you've shown that character where you do manage debt well, then that will definitely help you.
That's right. Now, I mean, character is not a deal breaker in the sense that if you're new to a bank, it's not by any means a deal breaker. But if you're asking for exceptions, then you'd rather ask for an exception with somebody that you're dealing with than somebody that's brand new, right?
Yeah.
And then credit is basically your credit score itself. So any lender is going to pull your credit bureau. On your credit bureau, there's 2 things they're looking for. They're looking for a score. That score has to be above 640. Let's write that down.
There you go.
Okay, that's typically what you need to be over to get, for most lending institutions. But score is not the only thing. So, a kid fresh out of high school, 19 years old, applies for his first credit card, makes a few payments, has a credit score of 640, doesn't mean he's getting approved for a mortgage. It just means he's got a score of 640. They're looking for other lines of credit. Well, okay, how long have you been established? How many credit cards do you have? What's the payment history? Have you been late more than 30 days, 60 days, 90 days? Is there any R1, R3s, or R4s, or R5s? It just means, you've been late several times past the 30-day grace period, right? So they're looking for that. maybe you've got a great score, but you've had 2 previous bankruptcies, right? And maybe it's been 30 years since your last one. But they're going to look at all those things, and depending on how long it's, the delinquency has been on your bureau, it may or may not show up.
And this is where it can come back to character based on that history. And remember that your credit score is important, but at the end of the day, it's the history of that score that they're going to look at. And
Right.
if you don't show the ability to manage debt over time, that's history, and manage different types of debt, that might create some concern for them. That's where the new individual has challenges.
So Rodney in Montreal, sorry, we didn't get to your question. Yeah, so $150 a month times 12, correct. But when I was doing the calculation, I was just doing a monthly calculation, right? So I took $150 plus the car payment, right? Okay, so getting back to the 5 C's of credit, if you can do some underwriting on your own and figure out what these numbers are, then you've got a pretty good idea if you're going to get approved or not. You can always ask for your credit report from the lender. They should give it to you. You can also go online and pull it up yourself. You'll have to pay a small fee, and they'll give it to you. And then just do this as a practice. Figure out where you're at, right? Throw these numbers down in a spreadsheet. Figure out what your GDSR and TDSR are. There's calculators. You can Google GDSR and TDSR calculator, and you'll find Excel spreadsheets that figure it out for you. You just input the numbers, and it'll spit out a number for you, and it'll tell you if you're 32% and under and 42% and under. Just so you're not wasting your time when you get to the bank, right? The worst thing that can happen is you're gung-ho about a deal, you walk into a bank, you've got no idea where you stand, and then, you're declined. So figure out where you're at before you even, attempt to go out and borrow money.
And
It's a simple exercise. It really is.
And that way you can make adjustments prior to approaching that lender.
That's right. Get some credit cards, pay down if you have to, things like that. Are we good here, guys, before I jump to the next section? If you're a guarantor on their birth, yep, that shows up. That's the thing, right? So if you guys are co-signing for loans and mortgages, it shows up on your bureau. The lender doesn't care if you've co-signed or not. They're going to take that payment, and they're going to count it against you.
Can I ask you something?
Yeah.
Are we gonna talk about programs?
Yes, I want to go to the Canada Guarantee website right now.
Okay, all right. That's
Okay.
good. Yeah.
Just any other questions before we jump to the next section? Everyone good? Good.
Good. Okay, we're gonna wrap up in about 5 to 7 minutes. Okay, so we're just gonna go over one more
Can
section.
they see everything?
Yeah.
we're doing?
So no, they won't be able to see it, but we'll
No.
do that. Okay. So here you can Google. Just go to that site here, right
Yeah,
there.
I think it's.
See, you know the site
I
actually.
think so. I think it's just.
Okay.
And there it is.
Oops.
Yeah, I think it's doing the line part.
Can you press it again? There. See, right there. That's it.
That's right. You can kind of just do it with the like this.
So yeah, you can. I'm just.
Okay.
So why don't we give them this site, right?
Okay, so they can't see what we're doing here?
Yeah, they can.
Okay.
I can do it. I'm just gonna give it to them. Okay.
Okay.
So just so you know, this is the site we're accessing. I'm going to share my screen. Tark's going to control it, but I just want to show you the site that we're talking about. There we go. So let's share that with everybody.
And the only reason why I'm using this insurer, they're the newest in Canada. They're the most relaxed, lenient. The main one that everybody knows about is CMHC. The second one is Genworth. They probably do, the bulk of the deals in Canada after CMHC. Canada Assure is new to the scene, but like I said, they're small, they're agile, they're a bit more relaxed in their lending, and they got some really good programs.
Okay.
So let's go there,
Sure.
and let's take a look at some of the programs they have set up, right? So there's your everyday conventional deal. You're putting down 20%. When you're putting down 20%, one of the misconceptions is, even though you're putting down 20% down payment, you're still, the lender still wants the insurance on the deal. They want insurance in case you default. The only difference is, if you're putting down 20% or more, the lender will pay the insurance dues. If you're putting down less than 20%, you've got to pay the bill. You're paying the premium, right? And it could be as high as 4 or 5% on the entire deal to get that insurance. Most lenders want the insurance, so they're going to price it right in there. But they'll pay for it out of their own pocket if you're putting down more than 20%, okay? We get a question here. Are credit scores valid the same for Inc.?
For the what, sorry?
Are they evaluated the same for rank? Yeah, I mean,
For company?
for companies, yeah.
Company. Sorry, is that okay?
Okay, fine.
Yeah. So a company has to create its own history. Yeah, the same things apply to a company, but that's something you establish over a couple years. You know, usually it's 2 to 3 years before an institution will give you a loan and have the company itself be the mortgager. So
What did they ask for personal guarantees?
yeah, they want personal guarantees initially, just as you establish that. Now, you know what? We could save those questions for Adnan when he jumps on the call. He's a contract lawyer and corporate lawyer, and he'll be able to answer those questions better than Tarek and I.
So default insurance is basically a guarantee to the lender that if for any reason you're unable to pay your mortgage due to whatever, there's insurance in place to cover the lender, right? And these programs are in place to cover the lender. They're not here to cover you, they're here to cover the lender. So you're paying for insurance for the lender, to protect the lender. If we go to insurance products, these are the different products here that are available. Okay. All right, so let's look at the low doc advantage self-employed, for example, at the bottom.
Okay.
Yep. This is a nifty little one, okay? So here's the requirements here. So they're saying maximum amortization they'll do is 25 years. Your credit score, you have to have a strong credit profile. So chances are they'll probably want more than 640. Maximum loan to value is 90% loan to value for purchase 1 to 2 units.
Which is pretty great, actually.
Which is pretty good. Interest rates, I mean, that's your standard. Maximum property value must be $1 million, et cetera, et cetera. But I want to go to the bottom here. So borrower qualifications. Self-employed for a minimum of 2 years. At the bottom there, it talks about income requirements. So I got into a situation once where I had a hairdresser who has a very good income, but doesn't declare her income. So when she went the traditional route and wanted to get a traditional mortgage, she was declined because her notice of assessments, her income verification documents, which in her case would be her notice of assessments because she's self-employed.
Which she actually claimed.
Which she claimed. I mean, if you're employed, you're going to have a pay stub. A lender's going to want to see that pay stub to indicate what kind of income you're generating, and they're going to want to see your last 2 notice of assessments to see what income you've made in the past and to see if there's a history there. Well, with self-employed people, construction workers, hairdressers, bartenders, etc., these industries don't always declare how much they're making. So this program here accounts for that. So they say, okay, we recognize that you're in an industry where you might not declare your income. Tell us how much you make, and we will accept your stated income if it's reasonable. Right? So read it here. It says borrower income requirements. Canada Guarantee recognizes that self-employed borrower's income for the notice doesn't always represent their actual income. So they're saying, tell us how much you make, and if it's reasonable, you know what, we'll consider it.
And the reason is because when you're self-employed or you know you have a corporation, you have a way to write off things. They understand that a great deal of your lifestyle is paid through the business, right? And they only can recognize and tax what you have left over. So the assessment that they would use on a self-employed person would be different than that if it was a regularly employed person, because the regularly employed person has to produce that income to cover all their expenses, where the self-employed, most of their everyday expenses are covered through their business often.
So in the case of the hairdresser, for example, who made about $70,000 or $80,000 a year, but only showed 25. In this case, you know, she showed some bank statements over a few months periods. It just showed periodic deposits that accounted for, you know, $4,000 or $5,000 a month. And being that she's in that industry, it's reasonable that a hairdresser would make $70,000 or $80,000 a year. But if you've got a construction worker claiming he makes $500,000 a year, that's unreasonable. They wouldn't accept it, right? But if he's showing $40,000 on paper, but he says he makes $90,000, that's acceptable and that's reasonable. And if you've got good income, or sorry, if you've got good credit and all the other criteria is met, they will do this deal.
Yeah.
Now, mind you, if you're only putting down 10% down payment, the fee or the insurance premium on this deal is going to be slightly higher than a conventional deal where they're using traditional income verification documents.
Yeah.
Okay? So, and every lender has different ways to verify income. Some will say, give us your notice of assessments, give us your pay stub, give us your T4 for the year, and then show us your bank statements, show me those deposits actually going into your account, right? Because, I mean, we've had a point there was a client once, for example, that was on maternity leave and wasn't going back to work, provided us with 2 notice of assessments, which proved her income in the past, didn't show anything going forward, right? Didn't show what she's making currently. So depending on who you're borrowing the money from, they'll have different requirements.
Tor, can you just in the last few minutes, can you talk about new immigrants to Canada?
Yeah, let's
There's a
pull up
few
the
of us-
program.
Yeah,
Yeah, let's pull up the program.
yeah,
It's
yeah.
here.
Okay, so let's pull up that program. Because I know some of you on the call are new to Canada. So where's that? Right
Yeah,
here.
right there, and it's Maple Leaf Advantage. New to
Okay, so
Canada.
this is a great one for individuals that are new to Canada.
Okay, so maximum amortization again, 25 years. They'll go 95% loan to value. If it's over if it's under $500,000, a 5% down payment is required. If you're between 500 and $1 million, they're saying they'll do 5% on the first $500,000, and then 10% on the amount over that.
So this is a program that's basically giving you the first-time home buyer's option as an immigrant to Canada. This is wonderful.
So let's go through the rest of the requirements here, and maybe we can answer some questions that are popping up. Credit requirements are based on the loan-to-value ratio for the borrower. Option 1, International Credit Bureau. If you don't have an International Credit Bureau, here's the other option. 12 months rental payment history confirmed by a landlord. So if you're renting, all you got to do is go up to your landlord and say, hey, can you give me a letter saying that I've paid my rent for the last 12 months on time? 12 months bank statements confirming the rental payments, and 1 utility bill showing that you've paid your bills on time. I mean, that's pretty easy to do, right? Let me get to some questions here. Where was this? Okay, so let's start with Francis in Vancouver. You're saying, where was this? What is it you're referring to?
The institutions that he's talking about, this insurance company.
Sweden. Okay, no worries. I'll go back to some of the other questions.
Okay.
Okay, so if it's not my first home, would it still work? Marina, what if it's not my first? Okay, so I mean, you can have 2 homes, 5% down payment on both homes. Is that what you're referring to,
Please say
Marina?
that again.
So you're allowed in Canada. You're allowed to have as many homes as you like. As far as CMHC is concerned and default insurance, you're allowed to have 2 homes at 5% down payment. When you get to the 3rd home, they're going to want 20%. Okay?
Everybody get that? 2 homes at 5%. You can exercise the first-time home buyers twice, even with an existing property.
Okay, what if it's not? Okay, next question. So the mortgage is under my personal name, but the title of the property. But the title of the property is under my company, right?
That's right.
Yep.
That's right. Yeah, save corporation questions about the corporation, how to set up for Adnan, who's the corporate lawyer. But that, yeah, you're right. It is the corporation is the owner of the property. The mortgage who's holding the paper is going to be you. You're the individual initially, at least, that will be holding the mortgage.
Okay, Dave Kulak. What about rental property? Well, it depends. So if you're buying a home and it's your second home and you're going to rent it out, 5% down payment. If you're buying a duplex, it can also be if it's your second home, it can be 5% down payment. If you're buying,
the claim is sorry.
it's your second home. It's a rental property, which is fine.
Yeah.
You're
Claim
allowed
is that you could be occupying half of it. There's
Right. Just remember though, and I don't want to get too much into taxation and things like that, but once you go past your principal residence, anything that you're selling second or third home, there's obviously tax implications here,
that's
right?
where the corporations become
Right.
important.
Okay, Dave, I was just wondering what these guys want for down payment. Dave, are you talking about Canada Guarantee? Hoping for less than 20% off.
Oh,
Okay.
It's fine. And it was 90 with the other one.
What if you own 2 homes in the biz already?
No, if it's in the business, they're all business. They're all business. If it's in the business, they're all business properties. They're all investment properties. We're talking about personal residence. You can't purchase personal residence in a corporation and claim it as your personal residence, right? It's either personal residence or it's a business investment property. So you can have unlimited investment properties in your corporation. That really has nothing to do with it. You can't use that 5% or exercise the 5% first-time home buyers when you're buying properties in corporations. That being said, it doesn't mean you won't find lenders and or insurance that will allow you to come up to that 90% as a investment property. And Tarek doesn't have time to talk about it this time, but he will talk about lenders and insurance and ways and programs out there that allow you to get more of a loan on a property, investment property.
Yeah, so there's other programs. I mean, everybody should put Canada Guarantee in their favorites and just go through it. So, for example, there's another section here where it talks about your down payment. If you're unable to save the down payment and you want to borrow it from your credit cards or borrow it from a loan or borrow it from somebody, you can do that, right? So traditionally you can't. It's got to be money that you've earned yourself or a gift from a gift letter. But if you go through the different programs here, that is available to you. I can't talk about all the programs because we're short for time, but feel free to go through this website and get familiar with some of the programs, guys.
Did you hear that? Did you hear how that's huge? That's huge, right? You can fund the deposit or the down payment more specifically on a property through an alternate source. Show them that it's coming from an alternate source through these programs. And this is important for us because we want to stay transparent, okay? We don't want to defraud. We're not looking to deceive lenders on what we're doing. So the programs are out there. It's just about us fitting the right program with the right opportunity.
Yeah, the whole first home buyers thing, it's, you know, that was a label they put on these products years ago. It doesn't exist no more. You can buy 5 homes in 10 years, you know, and still be considered a first-time home buyer. I mean, that label's gone. All they're saying is, if you've got a minimum of 5% down payment, we will approve you for a mortgage based on a 5% down payment once, twice, 3, 10 times. But if you're ever going to own more than 2 at the same time, then you've got to pay more than 5% down payment.
Does everybody understand that? So it's not, you don't get a first-time home buyer once in your life. Your first-time home buyer really applies to your principal residence, right? So if you sold a house and you got into another house, we can use that. As Tarek's saying, first-time home buyers is just a label, right?
Yeah.
It's more about, is this your principal residence and are you wishing to put only 5% down?
The same in Vancouver. Can you use your RSP? Yes, you can. There's 2 programs there. There's an actual program called First-Time Home Buyers Program, which allows you to use up to $25,000 out of your RSP as a down payment towards your home. You've got to repay it back over a 15-year period. So if there's a husband and wife, and you both got $20,000 or $25,000 in your RSP, you can take that money out and use it as a down payment.
What's more exciting is able to use your self-directed RSP as an opportunity to invest directly into real estate.
Correct. That opportunity exists as well. Okay, guys? Sorry, we're past the time.
Yeah. So we're going to have to wrap up. Okay? It was a great session. Can we thank Tarek for coming out tonight and sharing with us? Thank you very much. And yeah, it was great. Yeah, thank you very much. Thanks, Tarek. That was awesome.
welcome,
That was
guys.
really good.
Yep.
So Tarek will visit us once a month, as will Adnan for corporate lawyer. We'll bring on some other Power Team members on to give us a better understanding of.
I'm going to leave I'll leave you my email address now.
Okay,
Right.
so
Tarek.Stephen. That's what I'm doing. At F55F.
F5.
Yeah, 55F.com.
Is that right? Okay, here's his email. Okay, I want everybody to remember, okay, use that email when we're talking about doing something, right? If it's questions related, I'd rather you wait until he visits us, okay? I want to make sure that we respect his time, right? And he'll definitely be more than happy to talk to you about, you know, if you're looking at your RSPs, financial advising, you're looking at, you know, mortgage, getting a mortgage first thing, you definitely Tarek can help you out with that, okay? Okay, we good? Any questions? Are we all good? If you're good, type in yes. Let me get back here. Give me 1 second. My apologies. I just got off the screen. I want to make sure that we're all okay. There we go. There we go. Yep, my pleasure. Okay, so couple last minute things. I want you to continue educating yourself. Get into those courses. Make sure that you know you're going through the on demand, and make sure you show up to these Tuesday calls. They're important. Okay, they keep you going. They keep you energized. And it's an opportunity for all of us to learn from each other's experiences. Okay, I want to thank everybody for coming out. I want to thank Tar for coming out. and I want to wish you a great week. Reach out if you need me. You know how to reach me, and